American debt finance is a long-evolving story that reflects the growth of the United States economy, the structure of its political system, and the changing beliefs of its citizens about money responsibility and the role of government. Debt in this context is not only a number written on government balance sheets. It is a living system that connects households, businesses, banks, investors, and institutions across the world. To understand American debt finance, one must see it as a relationship built on trust, expectations, and the promise of future productivity. From the earliest days of the Republic, debt played a role in shaping national stability. After independence, the young nation faced large obligations from war expenses. Rather than rejecting these obligations, leaders chose to consolidate them and honor them. This decision established credibility and allowed the government to borrow at lower cost in the future. Debt became a tool not only for survival but for building confidence in the new financial system. This early choice created a pattern that would repeat many times in American history. As the economy expanded through industrial growth, infrastructure development, and population increase, debt became a mechanism to move resources through time. The government borrowed to build roads, ports, railways, and later power grids and communication systems. These investments did not produce immediate returns, but they increased long-term productivity. Debt finance allowed the nation to enjoy the benefits of these projects before all costs were paid. In this way, debt acted as a bridge between present needs and future gains. The structure of American debt finance is deeply connected to its currency system. The United States issues debt primarily in its own currency. This gives it flexibility that many other countries do not have. Investors around the world demand United States government securities because they are considered safe, liquid, and reliable. This demand keeps borrowing costs relatively low even when total debt levels rise. The global role of the dollar strengthens this system by ensuring continuous interest in American financial instruments. However, this privilege also carries responsibility. Trust in American debt depends on confidence in political stability, economic growth, and institutional integrity. If investors believe that future policies will undermine growth or stability, borrowing costs could rise. Debt finance, therefore, is not only a technical issue but also a political and social one. Decisions made in legislative chambers influence perceptions in financial markets. American debt can be divided into several broad categories. Public debt refers to obligations issued by the federal government. This includes treasury bills, notes, and bonds purchased by individuals, institutions, and foreign governments. Intragovernmental holdings represent debt the government owes to itself, mainly through trust funds such as those supporting retirement programs. Beyond federal obligations, there is state and local government debt, which finances schools, transportation, and public services. Each layer adds complexity to the overall picture. Household debt is another major component of the American debt landscape. Mortgages, student loans, auto loans, and credit card balances shape the financial lives of millions. This form of debt finance allows households to invest in housing, education, and durable goods. When managed well, it supports upward mobility and economic participation. When mismanaged, it can lead to stress, inequality, and reduced consumption. Household debt levels often reflect broader economic conditions such as wage growth, interest rates, and employment stability. Corporate debt also plays a critical role. Businesses borrow to expand operations, develop products, and manage cash flow. Access to credit allows firms to grow faster than they could through retained earnings alone. In a healthy system, corporate debt is supported by future profits and productivity. Problems arise when borrowing is used primarily for short-term financial engineering rather than long-term value creation. Excessive leverage can make companies vulnerable during economic downturns. The federal government uses debt finance to smooth economic cycles. During recessions, tax revenues fall while spending needs rise. Borrowing allows the government to support demand through social programs, infrastructure projects, and emergency assistance. During periods of strong growth, deficits can shrink or turn into surpluses. In theory, this countercyclical approach stabilizes the economy. In practice, political pressures often lead to persistent deficits even during good times. One reason deficits persist is the structure of the budget itself. Mandatory spending programs grow automatically based on eligibility rules and demographic trends. As the population ages, expenditures on retirement and health programs increase. Discretionary spending, which includes defense and domestic programs, is debated annually but represents a smaller share of total outlays. Revenue depends on economic performance and tax policy choices. Balancing these elements is a constant challenge. Interest costs are a crucial but often overlooked aspect of debt finance. When interest rates are low, the cost of servicing large debt remains manageable. When rates rise, interest payments consume a larger share of the budget. This can crowd out other priorities or require additional borrowing. The relationship between debt levels, growth rates, and interest rates determines long-term sustainability. If economic growth exceeds the interest rate on debt, the burden can stabilize or even decline relative to the economy. The history of American debt shows periods of rapid increase followed by stabilization or reduction. Major wars have always led to sharp rises in debt. After each conflict, the economy expanded and debt relative to national output fell. The mid-20th century provides a clear example when debt from global conflict was gradually reduced through growth and moderate inflation. This pattern illustrates that high debt levels are not necessarily permanent if managed within a growing economy. Inflation plays a complex role in debt finance. Moderate inflation can reduce the real value of outstanding obligations. This benefits borrowers, including the government, but harms lenders who receive payments with less purchasing power. High inflation, however, undermines confidence and raises interest rates. The challenge is maintaining price stability while allowing enough flexibility for economic adjustment. Central banking institutions play a key role in balancing these forces. Monetary policy interacts closely with debt finance. When central banks purchase government securities, they influence interest rates and liquidity. These actions can support economic activity during crises but also raise concerns about long-term independence and fiscal discipline. The relationship between fiscal authorities and monetary authorities must be carefully managed to preserve credibility. Clear communication and transparent rules help maintain trust. Foreign holders of American debt often attract attention. Some view foreign ownership as a vulnerability while others see it as a sign of strength. In reality, foreign investors choose American securities because of their safety and liquidity. This inflow of capital helps keep interest rates low. At the same time, reliance on foreign financing means that global conditions can affect domestic borrowing costs. Economic stability at home remains the most important factor. Debt finance also has moral and generational dimensions. Borrowing today implies repayment tomorrow. Future taxpayers bear the cost of current decisions. If borrowed funds are used for investments that benefit future generations such as infrastructure, education, and research, the burden may be justified. If debt finances consumption without lasting benefit, it can create intergenerational tension. This ethical aspect often appears in political debates. Public understanding of debt finance is often shaped by household analogies. Governments are compared to families who must balance budgets and avoid excessive borrowing. While intuitive, this analogy is incomplete. Governments operate on a different scale and have tools such as taxation and currency issuance. Still, the analogy highlights the importance of responsibility and long-term planning. Clear explanations can improve public discourse and policy choices. Political polarization complicates debt management. Competing visions of government-sized taxation and social priorities lead to stalemates and short-term solutions. Temporary funding measures and last-minute agreements create uncertainty. Financial markets generally assume that obligations will be honored, but repeated crises can erode confidence over time. Stable governance supports stable debt finance. Technological change influences debt dynamics as well. Advances in financial markets allow faster trading, broader participation, and more complex instruments. This increases liquidity but also introduces new risks. Transparency, regulation, and oversight are necessary to prevent excessive speculation and systemic instability. A well-functioning financial system supports efficient debt issuance and management. Education plays a vital role in shaping future outcomes. Citizens who understand basic principles of debt finance are better equipped to evaluate policy proposals. Financial literacy helps individuals manage personal debt and participate responsibly in the economy. At the national level, informed debate can lead to more sustainable choices. Knowledge reduces fear and misinformation. Looking ahead, American debt finance will continue to evolve. Demographic shifts, climate-related investments, and technological transformation will require significant resources. Debt will likely remain a tool to address these challenges. The key question is not whether debt exists but how it is used and managed. Prudence, transparency, and a focus on long-term growth are essential. Sustainability depends on aligning borrowing with productive capacity. Investments that raise future output make debt easier to carry. Policies that support innovation, workforce development, and infrastructure strengthen this alignment. At the same time, controlling costs and improving efficiency protect fiscal space. Balance rather than extremes offers the most resilient path. In conclusion, American debt finance is neither purely a problem nor purely a solution. It is a mechanism shaped by history, institutions, and choices. When used wisely, it enables growth, stability, and opportunity. When neglected or abused, it can create fragility and conflict. Understanding its complexity allows for more thoughtful discussion and better decisions. The story of American debt finance continues to be written, with each generation contributing to its direction and meaning.